Something has changed in the structure of the silver market, and whether you hold this metal or not, the next 12 to 18 months will likely clarify what that change means. This isn't about predicting prices or generating excitement. It's about recognizing a pattern that has appeared before in financial history, understanding what typically follows, and making sure you're positioned thoughtfully, not emotionally. If you've been watching silver, you've probably noticed the volatility, the sharp moves, the contradictions between what fundamentals suggest and what price action delivers. And if you're like most people, you might feel confused about what comes next. That confusion is understandable, but it's also a signal that something deeper is unfolding beneath the surface. This video is for two groups of people. First, those who already hold silver and want clarity on whether to stay patient, add more, or reconsider their position. Second, those who don't own silver, but sense that something in the broader financial system is shifting and wonder if this asset deserves attention. Both perspectives matter, and both require the same foundation, understanding what's actually happening, not what the headlines claim. Let's start with what has changed. For years, silver existed in a strange space. It was simultaneously an industrial metal and a monetary asset, caught between two worlds and never quite fitting cleanly into either. Investors knew it was undervalued relative to historical norms. They understood the supply constraints. They recognized the growing demand from solar, electric vehicles, and technology. And yet, the price remained stubbornly disconnected from those fundamentals. That disconnect is beginning to narrow, not overnight and not in a straight line, but the forces that kept silver suppressed are showing signs of strain. Central banks around the world have shifted their behavior. Debt levels have reached points that cannot be serviced under normal interest rate conditions. Currency debasement is no longer theoretical, it's policy. And investors, both institutional and individual, are slowly waking up to the fact that hard assets may be the only reliable store of value in an environment where paper promises are being diluted at an accelerating pace. Silver, specifically, sits at the intersection of two massive trends: monetary uncertainty and industrial necessity. It's needed for the energy transition. It's required for electronics, medical devices, and defense systems. And simultaneously, it's one of the oldest forms of money, trusted for thousands of years when confidence in governments and central banks falters. The change isn't that silver suddenly became important. The change is that the conditions which made it easy to ignore are disappearing. And markets don't transition smoothly. They move in waves, and right now, we're entering a phase where those waves are getting harder to predict and more volatile to navigate. This is the defining moment. Not because silver is about to explode or crash, but because the stability that allowed for complacency is ending. And in that ending, decisions made today will matter more than decisions made in calmer times. The biggest mistake investors make with silver is treating it like a stock. They expect quarterly earnings reports, predictable patterns, and clean narratives. But silver doesn't work that way. It's a hybrid asset, influenced by monetary policy, industrial demand, geopolitical risk, and investor sentiment all at once. That complexity creates noise, and noise creates confusion. Most people also misunderstand the timeline. They hear about fundamentals improving and expect immediate results. When the price doesn't move as expected, they assume the thesis was wrong. But markets don't operate on our schedules. They operate on cycles, sentiment shifts, and structural changes that take time to fully express themselves. Silver, in particular, has a history of long periods of consolidation followed by sharp, explosive moves that catch most participants off guard. There's also a widespread misconception about what drives silver prices. Many believe it's purely about supply and demand in the physical market, but the reality is more layered. The paper market, where silver is traded as contracts and derivatives, dwarfs the physical market by a significant margin. That means price discovery happens in a space where actual metal doesn't change hands and where financial institutions, not end users, set the tone. This structure has created distortions, prices that don't reflect physical tightness, sudden moves that seem disconnected from news, and a general sense among investors that silver is manipulated or broken. Whether manipulation exists is a separate debate, but what matters is understanding that the market structure itself creates volatility and inefficiency, and in times of stress, those inefficiencies become opportunities for those who understand them. Another reason people misunderstand this moment is because they're comparing it to the wrong historical examples. Many look at 2011, when silver briefly touched $50, and assume that's the target or the model. But 2011 was driven by a specific set of conditions: a post-financial crisis environment, zero interest rates, and a speculative frenzy in commodities. Today's setup is different. It's less about speculation and more about structural realities that can't be papered over indefinitely. If you're waiting for silver to behave the way it did in the past, you'll miss what's unfolding now. This isn't a replay, it's a new chapter, with different actors and different catalysts. Understanding that difference is critical. Let's talk about what's happening in the broader economy, because silver doesn't exist in isolation. It reacts to forces much larger than itself, and those forces are shifting in ways that matter. First, inflation. Not the temporary kind that central banks can manage with a few rate hikes, but the structural kind that emerges when governments have too much debt and too few options. When you owe more than you can realistically repay, you either default or you devalue. History shows that governments almost always choose devaluation. That means printing more currency, expanding the money supply, and hoping that inflation reduces the real burden of debt over time. Silver, like gold, benefits in that environment. Not because it goes up in absolute terms, but because it maintains purchasing power while paper currency loses it. This isn't speculation, it's pattern recognition based on decades of data across multiple countries and monetary systems. Second, interest rates. We've been through an extraordinary period where central banks raised rates aggressively to combat inflation. That worked to an extent. Inflation cooled, but the cost of that cooling was economic slowdown, stress in regional banking, and mounting pressure on governments struggling to service their debt at higher rates. Now, central banks are caught. If they keep rates high, they risk breaking something in the financial system. If they lower rates, they risk reigniting inflation. Silver typically struggles when real interest rates, adjusted for inflation, are high. Because in that scenario, holding a non-yielding asset like silver has an opportunity cost. But when real rates are low, zero, or negative, that cost disappears. And right now, despite nominal rates being elevated, real rates are compressing. That shift matters. Third, currency instability. The US dollar has been the global reserve currency for decades, giving the United States an extraordinary privilege, the ability to print money and export inflation. But that privilege is being questioned more openly than at any point in recent history. Countries are settling trade in their own currencies. Central banks are diversifying reserves away from dollar-heavy allocations, and trust in the stability of fiat systems is eroding, slowly but visibly. When confidence in currency weakens, hard assets strengthen. It's not immediate and it's not guaranteed on any specific timeline, but the direction is clear. And silver, as one of the most accessible hard assets, stands to benefit from that trend. Fourth, debt expansion. Government debt across the developed world is at levels that would have been unthinkable 2 decades ago. Debt to GDP ratios are climbing, deficits are normalized, and there's no political will to reverse course. This debt can't be paid back through growth alone. That means it will either be inflated away or restructured, and both scenarios are bullish for tangible assets that can't be printed. These aren't predictions, they're observations about the environment we're already in. And for silver, this environment is more favorable than it's been in years. Understanding cycles is one of the most valuable skills an investor can develop. Markets don't move in straight lines. They oscillate between optimism and pessimism, greed and fear, accumulation and distribution. And those who recognize where we are in the cycle can position themselves accordingly. Silver tends to move in multi-year cycles, long periods of quiet accumulation where the asset is overlooked and undervalued, followed by shorter, more intense periods of recognition, where prices rise sharply and everyone suddenly pays attention. Then exhaustion, where late participants get caught at the top, followed by another long period of consolidation. Right now, we're likely in the late stages of a consolidation phase. Not at the bottom, because bottoms are rarely clean or obvious, but in a zone where the downside risk is limited and the upside potential is expanding. This is the phase where patient investors build positions, not because they know exactly when the next move will come, but because they understand probabilities and they're willing to be early. Investor psychology plays a huge role in how these cycles unfold. When silver is ignored, the narrative is that it's a dead asset, that it's been overtaken by better investments, that the fundamentals don't matter. But when silver starts moving, that narrative flips. Suddenly, everyone remembers why they liked it in the first place. The same fundamentals that were dismissed months earlier become the reason for excitement. This psychological whipsaw is predictable, but it's also difficult to navigate emotionally. Most investors buy when the narrative is positive and everyone is talking about it. Then they sell when the narrative turns negative and everyone is dismissing it. That's how wealth is transferred from impatient hands to patient ones. If you're serious about silver, you have to be comfortable holding through the noise. You have to accept that there will be periods where nothing happens, where your thesis feels wrong, where doubt creeps in. That's the cost of positioning ahead of the crowd. But it's also the only way to capture meaningful returns when the cycle finally turns. If you already own silver, this moment is about patience and perspective, not action. You've made a decision based on a thesis, and unless that thesis has fundamentally changed, there's no reason to second-guess yourself now. The hardest part of holding any asset is enduring the waiting period. Silver, in particular, can test your resolve because it moves violently in both directions. One week it's up 10%, the next it's down 8%. That volatility is draining. It makes you question whether you're in the right place. But here's what you need to remember. Volatility is not the same as risk. Risk is the permanent loss of capital. Volatility is just price movement, and in the case of silver, much of that movement is noise generated by the paper market, not changes in the underlying fundamentals. If you understand the difference, you can tolerate the swings without panicking. Your job as a holder is not to predict where silver goes next week or next month. Your job is to stay grounded in the reasons you bought it in the first place. Is the debt problem getting better or worse? Is currency debasement slowing or accelerating? Is industrial demand for silver shrinking or growing? Is geopolitical risk declining or intensifying? If the answers to those questions support your original thesis, then the current price is just noise, and noise over time gets resolved. The trend reasserts itself. The fundamentals eventually matter, but only if you're still there when it happens. And one more thing for holders. Don't let short-term price action dictate your strategy. If your plan was to hold silver for 5 years as a hedge against monetary instability, then a 5% pullback this month is irrelevant. If your plan was to accumulate over time, then use weakness as an opportunity, not a reason to retreat. Discipline beats emotion every time. And in markets like this, discipline is what separates those who build wealth from those who chase it. If you don't currently own silver, the question isn't whether you should rush in today. The question is whether this asset belongs in your portfolio at all, and if so, how much? Start with the basics. Silver is volatile, illiquid compared to stocks or bonds, and it generates no income. It sits in your portfolio doing nothing except maintaining its physical existence. That's not a problem if you understand what it's for. Silver is a hedge, not a growth investment. It's insurance against scenarios where paper assets lose purchasing power, where trust in financial systems erodes, where the conventional portfolio of stocks and bonds doesn't provide the protection you need. If you believe those scenarios are unlikely, then silver probably isn't for you. But if you believe they're possible, even if not probable, then a small allocation makes sense. Not 20 or 30% of your net worth. Not leveraged positions or speculative bets. Just a reasonable measured allocation that reflects the level of monetary uncertainty you perceive in the world. The mistake most people make is waiting for confirmation. They want silver to start moving before they buy, because that movement feels like validation. But by the time the move is obvious, you've missed the best entry points. The time to build a position is when it feels uncomfortable, when the narrative is skeptical, when the price is consolidating after a period of weakness. That doesn't mean you should buy blindly. It means you should do the work. Study the fundamentals, understand the risks, decide on an allocation that makes sense for your situation, and then execute that allocation calmly without trying to time the exact bottom or catch the perfect entry. One approach that works well is dollar cost averaging. Instead of committing all at once, spread your purchases over time. Buy a little each month, regardless of price. That removes the emotional burden of trying to time the market, and it ensures you're building a position consistently without overcommitting at any single point. For those who don't own silver and are considering it, this is a moment to educate yourself, not to react. Take time to understand what you're buying and why. Don't let FOMO or fear drive your decisions. And remember, no single asset is the answer to everything. Silver is one tool among many, and it works best as part of a diversified strategy, not as a standalone bet. History doesn't repeat, but it often rhymes, and silver's history offers valuable lessons for anyone trying to navigate this moment. In the 1970s, silver went from under $2 to over $50. Driven by inflation, currency instability, and a crisis of confidence in government policy. Then it collapsed, spending decades in a bear market. In the 2000s, it rallied from under $5 to nearly $50 again, driven by post-financial crisis, monetary expansion, and commodity speculation. Then it collapsed again, consolidating for over a decade. The pattern is clear. Long periods of quiet, followed by explosive moves, followed by painful corrections. And in between, a lot of waiting, a lot of doubt, and a lot of investors who give up right before the turn. The lesson isn't that silver always goes up. It doesn't. The lesson is that when conditions align, silver moves faster and further than most people expect. And those conditions, monetary instability, excessive debt, currency debasement, are aligning again now. But here's the other lesson. Timing is nearly impossible. The investors who made money in silver weren't the ones who predicted the exact bottom or top. They were the ones who recognized the environment, built positions during accumulation phases, and held through the noise until the fundamentals expressed themselves in price. In 1979, most investors weren't buying silver. It had been dormant for years, and the narrative was that precious metals were relics. But those who understood the inflation problem and the currency crisis bought anyway. And when the move came, it was swift and dramatic. In 2008, after the financial crisis, most investors weren't buying silver. The economy was collapsing. Deflation seemed more likely than inflation, and risk assets were being sold indiscriminately. But those who understood what central banks would do next, print money on an unprecedented scale, bought anyway. And within 3 years, silver had quintupled. Today, we're in a similar setup. Not identical, but similar. Debt levels are extreme. Central banks are trapped. Currency debasement is policy. And silver is consolidating after years of underperformance. The conditions for a move are present. The timing is uncertain. But the probability is shifting in favor of those who position early, not those who wait for confirmation. History also teaches us about the risks. Silver is not a one-way trade. It crashes hard when sentiment shifts, when margin calls force selling, when speculative excesses unwind. Anyone holding silver has to be prepared for that volatility, both psychologically and financially. Over-leveraging is how people lose everything, even when their thesis is eventually proven right. The investors who succeed with silver are the ones who treat it as a long-term allocation, not a short-term speculation. They don't use leverage. They don't check the price every day. They don't panic when it drops or get euphoric when it rises. They just hold patiently, knowing that in a world of monetary instability, tangible assets tend to preserve wealth better than paper promises. Let's talk about the mistakes you need to avoid, because knowing what not to do is just as important as knowing what to do. First, don't react emotionally to short-term price swings. Silver will move up and down, sometimes dramatically, and those moves will feel significant in the moment. But unless you're a day trader, which you shouldn't be, those swings are noise. Your strategy should be based on fundamentals and time horizon, not daily price action. Second, don't over-leverage. The temptation with silver, especially when you're convinced the fundamentals are strong, is to use leverage to amplify returns. Futures contracts, margin accounts, leveraged ETFs. These tools can multiply gains, but they also multiply losses. And in a volatile market, leverage is how you get wiped out right before you would have been proven right. If you can't afford to hold the position through a 50% drawdown, you're overexposed. Third, don't chase headlines. Every day there's a new story, a new prediction, a new reason to buy or sell. Analyst X says silver is going to 100. Analyst Y says it's going to 10. Ignore the noise. Headlines are designed to generate clicks, not to provide clarity. Base your decisions on fundamentals, not on what someone tweeted or what a YouTube video claimed. Fourth, don't follow the crowd blindly. When silver starts moving, everyone will have an opinion. Friends, family, online communities, financial media. Most of those opinions will be based on emotion, not analysis. Do your own research. Understand your own risk tolerance. Make your own decisions. Herd mentality works until it doesn't, and when it fails catastrophically. Fifth, don't ignore liquidity. Physical silver is less liquid than paper silver. If you need to sell quickly, you might not get the price you want. That's why physical should be viewed as a long-term holding, not something you plan to flip for a quick profit. And within physical, smaller denominations like 1-ounce coins are more liquid than large bars, so structure your holdings accordingly. Sixth, don't assume this is easy money. Silver is not a get-rich-quick scheme. It's a hedge, a store of value, a way to diversify away from paper assets. If you're expecting guaranteed returns on a predictable timeline, you're going to be disappointed. The right mindset is that silver is insurance. You buy it, hoping you don't need it, but grateful to have it if conditions deteriorate. Seventh, don't neglect the rest of your portfolio. Silver should be part of a broader strategy, not the entirety of it. You still need liquidity. You still need income-producing assets. You still need diversification. An all-in bet on any single asset, no matter how compelling the thesis, is a recipe for regret. The investors who succeed over the long term share one trait above all others: discipline. Not intelligence, not luck, not perfect timing. Discipline. The ability to stick to a plan, to ignore noise, to act rationally when emotions are screaming. Discipline means buying when it's uncomfortable and holding when it's boring. It means sizing positions appropriately, not overcommitting when you're confident or undercommitting when you're nervous. It means having rules and following them, even when the market makes you question those rules. Patience is the companion to discipline. Markets don't care about your timeline. They move on their own schedule, driven by forces too complex and interconnected to predict with precision. If you need results quickly, you'll make poor decisions. If you can wait, if you can endure periods of nothing happening, you give yourself the chance to be there when things finally do happen. Silver, specifically, rewards patience more than almost any other asset. The waiting periods are long, the moves, when they come, are fast, and the investors who capture those moves are the ones who were positioned before the crowd arrived, not the ones who jumped in after the confirmation. Think of it this way. You're not trying to outsmart the market. You're trying to outlast it. You're not trying to predict the exact moment silver turns. You're trying to be positioned when it does. That requires a different mindset, one that values process over outcome, preparation over reaction. This is where most people fail. They lose patience. They see other assets performing and wonder why they're stuck holding something that isn't moving. They doubt their thesis. They sell at the worst possible time, right before the turn. And then they watch from the sidelines as the move they were waiting for finally happens. Don't be that person. If you've done the work, if you understand the fundamentals, if you've sized your position appropriately, then trust the process. The outcome will take care of itself, but only if you're still there when it arrives. So where does that leave us? Silver is at a crossroads, not because of a single event or catalyst, but because the conditions that have suppressed it for years are shifting. Debt is unsustainable. Currency debasement is accelerating. Industrial demand is growing. And investor awareness is slowly building. This doesn't mean silver is going to explode tomorrow. It doesn't mean you should rush out and buy as much as you can. It means the risk-reward profile has shifted in a way that favors those who position thoughtfully and patiently. For holders, this is a moment to stay grounded. Review your thesis, make sure it still makes sense. If it does, ignore the noise and hold. If it doesn't, exit gracefully without emotion. But don't let short-term volatility dictate long-term strategy. For non-holders, this is a moment to educate yourself. Understand what silver is, what it does, and whether it belongs in your portfolio. If it does, start building a position calmly without trying to time the perfect entry. If it doesn't, that's fine. Not every asset is right for every person. The key is to approach this without emotion. Silver is not a savior, and it's not a scam. It's a tool, one with specific characteristics and specific uses. It thrives in certain environments and struggles in others. Right now, the environment is becoming more favorable, but favorable doesn't mean guaranteed, and it doesn't mean immediate. What separates successful investors from everyone else is the ability to stay rational when others are emotional, to stay patient when others are impatient, to stay disciplined when others are reactive. Those qualities matter more than any prediction, any price target, any piece of breaking news. We're living through a period of financial transition. The old certainties are eroding. The systems we took for granted are showing strain, and the question every investor has to answer is, how do I protect what I've built while positioning for what comes next? Silver is one answer among many. It's not the only answer, and it's not right for everyone. But for those who understand its role, who see the value in holding something tangible in a world of paper promises, it offers a form of insurance that few other assets can provide. The defining moment isn't about predicting when silver moves or how high it goes. The defining moment is now, and how you choose to respond to uncertainty. Do you react emotionally, chasing headlines and doubling down when you're confident, selling when you're scared? Or do you respond thoughtfully, building positions when it's uncomfortable, holding when it's boring, staying disciplined when the crowd is panicking? That choice, more than any market move, will determine your outcome. Because in the end, markets reward preparation, patience, and process. They punish emotion, impatience, and reaction. If you hold silver, stay the course. Review your thesis regularly, but don't let noise change your plan. If you don't hold silver, consider whether it deserves a place in your strategy. And if it does, act calmly and deliberately, not impulsively. The crisis isn't coming. It's here. Not in the sense of panic or collapse, but in the sense that the financial landscape is shifting in ways that demand attention. Those who recognize that shift and position accordingly won't get rich overnight, but they will preserve wealth, avoid catastrophic mistakes, and give themselves the opportunity to benefit when the cycle finally turns. Stay informed, stay disciplined, stay patient. And remember, understanding the game matters more than predicting the outcome. The investors who thrive in uncertain times aren't the ones with perfect foresight. They're the ones who stay rational, build thoughtful strategies, and execute with discipline. This is your moment to choose which investor you want to be.